Hi, this is Jay McLaughlin. I, along with my co host Paul Cates, welcome you to the Realty Project Podcast, a podcast with a focus on real estate investing, and business. Our guest is a loan originator. She helps prospective borrowers secure the right mortgage for a real estate transaction, be it residential and or commercial. She's owned a company whereby she oversaw 30 plus loan officers, I should say. She knows the lending industry like the back of her hand. When talking to those I refer to her for a residential and or commercial loan, I tell them if Vicki can't get you finance, you can't get finance. That's how good she is. On the Realty Project podcast is Vicki Nelson, MoneyWise Lending loan originator extraordinaire. Welcome, Vicki.
Thank you, Jay. Thank you very much.
Now, I've got some interesting information for you too. Following its January 31st through February 1st meeting, the Federal Reserve announced that it's raising interest rates by 0.25 percentage point, bumping the federal funds rate to a target range of 4.5 to 4.75%. With the move, the Federal Reserve marked the eighth straight meeting that it raised rates in an effort to rapidly reduce liquidity to the financial markets and tap down high inflation. The Fed's decision comes as inflation hit 6.5% as of December of 2022, still among the highest levels in decades. With the Fed hitting the brakes on an overheated economy, the main question for many market watchers is how much further will the Fed raise rates and how deep will an ensuing recession become? While inflation pressures have started easing, many feel the Fed's work is not complete. Interest rates are moving higher and may stay there longer than is generally believed. The Fed funds rate controls the amount that banks charge each for short-term borrowing, but also serves as a signpost for many forms of consumer debt. Now, listen, we know that, Vic, if we were to ask you what's going to happen in the next few months here in 2023, be it concerning rates, you'd be a billionaire by now. So we know we're not going to ask you that. But what I am going to ask you is, how is 0.25 percentage of a point, how will that affect the average person?
First of all, you've got to remember Fed rates when you just told me they bumped a quarter. That's Fed rates. That's what banks loan money to other banks. That doesn't have, so that does affect your mortgage to some degree, but it doesn't affect it to a quarter of a point. Okay. What investors look at that are backing the mortgage securities is they do look at what that rate is, of course, because that's going to affect it. But they also look at what the inflation is. They also look at the fact that everyone is looking at more than likely, again, that rates will go down in the future. So the mortgage investors are saying, oh no, we're going to give rates at this point, but we're going to really want to make some money on what the loans we're doing right now, because we know people are going to probably refinance them in a year or so from now. And a lot of times the lenders make money not just by doing the original origination, but by keeping and servicing the loan long term. So they have to, when they're determining the mortgage rates, they're also determining all those factors into it, not just because the Fed raised the rate a quarter of a point.
Yeah, got to make the margin.
Yep.
Speaking of loans, can you share with us the differences in loans? Let's start with conventional. What's a conventional loan?
Yeah, a conventional is a normal Fannie Freddie loan. You can go up to $726,200 on it, which got raised this year, and that's for someone who can qualify as far as for their credit and their assets and so on, more so than what they can on an FHA. Let me tell you the difference between, number one, FHA doesn't go as high. They only go 400 and something thousand for an FHA loan. So part of it depends on the price of the home that you're buying and the loan amount that you need. So the different types of loans, if you want me to explain them real quick, you've got your conventional, your FHA, your VA, your USDA, and then your specialty type of loans.
Okay.
And so the big determining factor on whether somebody's going to go conventional or FHA depends a lot of times on their credit score. On FHA, you can go all the way down to actually 550, whereas with conventional, if you've got 620 is the minimum, but even with 620, it's very hard to get a conventional loan through. And even if you do, on a conventional loan, if you have less than 20% that you're putting down, then you have to pay what's called private mortgage insurance. And the lower the credit score, the higher the PMI. Whereas on FHA mortgage, it doesn't matter if your credit score is 620 or 580 or if it's 740. FHA, the private mortgage insurance or mortgage insurance premium with FHA is 1.75% added to the loan amount, and then they charge either 0.8 or 0.85%, depending on if it's 3.5 or 5% down, throughout the life of the loan.
Okay.
FHA also will give you a little bit better interest rate than conventional. However, the reason why I usually tell people, if you're in a position to go conventional, you're much better off than going FHA, because number one, you don't get the 1.75 added to your loan amount. And number two, if your credit score is good, your private mortgage insurance is going to be less than what the PMI is on an FHA loan. But most of all, on an FHA loan, that PMI amount that you pay monthly stays there for the whole life of the loan. Whereas on a conventional loan, it drops off at, they say 80%, it usually is about 78% if you just let it ride out, so that you no longer have to pay that private mortgage insurance. So if you're in a position financially to be able to get a conventional loan, that's usually the best way to go. But FHA, we do them constantly and all day long, because a lot of times people will qualify for an FHA when they don't qualify for a conventional. Now, on a VA loan, you have to be a veteran. Hey, if you're a veteran, that's definitely going to be the way you want to go, right? USDA is a 0% down, same as your veteran is 0% down. However, you can only do those if the home that you're wanting to purchase is in an area that takes USDA loans, which are your smaller areas, less than 50,000 or so in population. So they're very limited as far as to the area that you're looking in. If you're looking into an area that does USDA, then that's great. Something else that's different between them is with conventional, you can go down to 3% if you're a first-time home buyer. If not, you're going to go 5% down. But the seller's only allowed to pay 3% for closing cost, 2% on an investor loan. On FHA, they're allowed to pay up to 6% of closing cost and prepaids for a borrower.
So, let me ask you a quick question. It may be a silly question. The USDA is based on where the property sits. Is that correct?
Correct, and there's never a silly question.
Got it. VA is, you're a veteran. There's obviously better terms here, right? Or preferred terms, we would say, because they serve the country, right?
Right.
FHA is if I got an FHA loan when I bought my first house, can I get an FHA loan when I buy my second house if it's my homestead? Or is it just one time?
It's not a one-time deal. As long as you've paid off that FHA, you're selling that FHA loan. There are some circumstances where you could get a second FHA loan if you're more than 100 miles away from the other one.
Okay. Right.
But for the most part, it's not limited in that respect. It's limited to, you can only have one out at a time usually, unless the circumstances allow for it.
Yeah, some of the stuff I hear, these like group think, rumors, if you will, right? And sometimes people say, "Hey, you already used your FHA." I'm like, "What are you talking about? What do you mean I just used my FHA? How many do I have in my life?" Right? And they're like, "No, it's first time." So that's why I asked the question. I think a lot of people out there don't really know you could, as long as you're selling your house, you can do another FHA.
Where a lot of people have that confusion is on VA loans too. They think if they've already used their VA loan, but that's not necessarily true. You have a certain amount that you can keep outstanding on VA. In fact, sometimes if you owe just a little bit left on one VA, you can still get into a second VA as long as you don't over exceed the amount that they're backing for you.
It's just like once you're a Marine, you're always a Marine, right? Once you're a veteran, you're always a veteran.
Yes.
Okay.
On the specialty loans, I'd like to bring up the ARM. and that's an adjustable rate mortgage. Can you explain a little bit about the ARM?
There's several different types of ARMs, but the one that's very popular right now is to where people are buying down the interest rate, and then it goes up the second year, and then it goes up the third year, and then it tops out, and then year 3 through 30 on the loan is that. And what makes it so special is because if you've got a willing seller, because it costs money to do that. But in this case, the seller is allowed to pay those discount points for the borrower. There's also different types of that adjust depending on the LIBOR or whatever it is that it's tied to, that it can adjust at any time, and it depends on what you're looking at. It could be maybe it's fixed for a certain amount of time, then it starts adjusting, or maybe it adjusts every year, every month. It just depends on the way that the loan is written to how many times it can adjust.
So when you say buy down the rate, what does that mean? Do I give you $1,000 and I get a quarter of a point off? Like, how does that work?
Yeah, discount rates or buying down the rate is you pay a certain amount of money to purchase the lower rate.
Okay, so but that happens like when you give a term sheet or something, right? Like, because I hear people talk about it and it's easy to internalize that, but mechanically I'm basically giving you cash today, so I don't have to pay 0.25% for 30 years. I'm just using some numbers.
That's basically it.
Okay.
In fact, when you get ready to what we call lock your interest rate, your loan officer should be going over with you. Here's what we call par, meaning you're not paying and we're not paying you to take this interest rate today.
Gotcha.
However, if you need help with your closing costs, we can raise your interest rate and give you money back to help pay your closing costs.
Gotcha.
Or if you'd rather have that lower rate, then you can pay money now to the lender and get a lower rate. It's all negotiable, so you really have to have your loan officer going over that with you when you're ready to lock in your interest rate.
They call you loan officers, but they should really call you like loan strategists, right? Because a lot of this seems like, hey, here's what it is, and here's kind of how you can move through it.
It is, and if you've got a good loan officer, they'll work with you on figuring out what your long-term plan is. If you just plan on staying in that house for a couple of years, usually it's better to take the higher rate.
Yeah.
Whereas if you say, no, I'm going to live here till, for the whole 30 years, and, average is 5 to 7 years, but let's just say, there are people that stay in there long-term, then you might very well be better. What we usually try to do is figure a break-even point for you.
Gotcha.
We'll say, okay, if you pay this amount of money, it's going to take you, and you stay in this home more than 2.5 years, that's your break-even point. Anytime after 2.5 years, you're saving money.
Gotcha.
However, if you so you have to figure it out for them, and no one knows the future for sure, but you can at least give them their break-even point for sure.
For sure. Okay.
Before we move on to the next question, though, I'd like you to share the dangers of securing an ARM, because if you take, let's say, a 2-year ARM, and so at the end, when that ARM expires, let's say you secured an ARM at 3% for 2 years. So after 2 years, would that still be at 3% on that third year? What would that interest rate be?
Okay, again, there's a lot of different types, but if you go with the fixed one, it's more of a stair step where you've got, what your interest rate's going to be year 3 through 30. It is locked in, it's just it stair steps up. But there's a lot of them out there that are not. They're tied to some type of index, and then they have a minimum and a maximum of floor of what that rate can be, and that's where a lot of people get in trouble. If you're going in and your rate today is 6%, or you wouldn't probably do that on ARM. Let's just say you're starting out at 4.5%. Maybe the maximum on that's 11%. So if rates just keep going on up, eventually, you're going to probably have an issue unless your salary is going up as well.
Yeah.
So we usually have always tried to, these last multiple years, fixed. But because of the interest rates jumping like they have, that's when people started talking ARMs again. And back, years ago, we used to do a lot of ARMs. We used to have something called a pick-a-pay. But nowadays, since a lot of people were priced out and couldn't afford the homes, is why they went back to doing the ARMs.
I had a young lady when I was in new home sales come to me, and she had purchased a home. She'd been in her home 2 years. She worked at a maintenance shop. She was there on time. She'd been working, I think, 10 years to save up this money to purchase a home. So what she didn't know is that whoever was assisting her gave her an ARM. So after 2 years, of paying her mortgage on time. Probably 6 months after that, she received the notice that she was being foreclosed on, and she had no idea. And so when I looked at her paperwork, I saw that it was an arm. And I tried to help her, but it was definitely a challenging feat to overcome. And that's why I wanted you to explain that, because a good number of people have been taken advantage of, thinking that they're getting a fix, a 30-year fix, or even if it's a 15-year fix, and they're not. They're getting an arm that, at the end, when that arm expires, that interest rate is, sometimes it could double.
Yeah, they usually have some type of safety measures as far as how much it can go up per year until it ceilings. But they're wrote in several. They're all wrote differently, so you really have to pay attention to what you're signing, and there should be a lot of disclosures going into it. And
I appreciate that.
But you're right. In order for her to foreclose, she should have been getting notices that her payment was going up. And
well, she did. She shared with me her payments were going up, but she didn't understand it. And by the time that she happened to come into the model that I was sitting in, and it was pretty much too late to help her.
Well, and I would also say, you're gonna have bad actors, you're gonna have bad information, and it sounds like, Vicki, we were talking just now about that loan strategist, right? If you should probably be a little weary if the interaction feels transactional, right? Hey, just get it going, get it, because nobody's really laying all that out for you. I think a lot of people take for granted that, okay, since I'm doing an official application, since I'm working with people, in suits and a collar, that clearly they've got their best interest, which they may be wondering, what show they're going to watch on Netflix, so it's important, I think, with what you do, is that, if somebody's not interacting with you and really kind of giving you all that, you should probably go the other way, right?
I totally agree with you.
Good point.
Yeah.
Also, another trap that people run into, not so much now because it's gotten a lot more regulated than it used to be back when we started having a lot of foreclosures for this, is that when they buy a home, the taxes on it that they're looking at, especially on new homes, might be lower, and then all of a sudden their taxes jump.
Oh yeah.
So
HOA too, right? Hey, look, there's 1,200 homes here. You're the first of two. Things may change, but they never really tell you how they'll change. Somebody's got to pay for all that irrigation.
Yeah, taxes can change a lot too. And always remember to file your homestead, and you have 2 years to go back if you haven't.
So one of the things, the next thing that we wanted to ask, and I'll modify it just a little bit based on how we're talking, but you got somebody that wants to buy a home, right? And what we'd like to do in this conversation is really arm somebody with, what requirements do they need to, I guess, understand and prepare for to secure one of these loans, but a loan in general, right? And the way I want to modify that is, Vicki, in your travels, I'm sure people are always walking around with their driver's license. I'm sure they think there's some money that has to be transacted, but what are some things that you've seen in your career that, well, first of all, what do people need? But what are the things that most people maybe forget or don't realize they need when they're coming to your office?
Sure. There's 3 things that you want to really strongly look at. That's your credit, and then, of course, your income, and then your assets, meaning what money you have to get into the property.
Okay.
Another thing that I hit on a lot is people don't realize that their immigration status can come into play as well too.
Okay, is that something they should say, Vicki? I just need you to know right now.
They do, and I try to make a habit. If they leave the information blank on are you a U.S. citizen, you don't have to be a U.S. citizen, but you do need to be here legally and have some documents to back it up, or you're going with a really specialty type of loan. And I actually run into that more often than you think. A lot of people do what we call I-10 borrowers, identification taxpayer numbers, and the IRS will allow you to pay taxes regardless if you're here legal or not. And so they'll have their tax returns, everything looks good, but then they still don't have their actual permission to be working here. And that can run into a problem to what type of loan you can get them. But again, I just wanted to throw that out there because I personally seem to run into it a lot.
Yeah, that's important.
But your income, the way that we figure the income, and that's another thing. The income that you put on your application is not necessarily the same way the lender will look at it.
Interesting.
So, number one, you want to put, if you work just a W-2 job, then that's good. You'll want to put down your gross amount, but your before taxes. However, you separate your base out from any overtime and bonuses that you get. People will put what their last paycheck was, and that's not necessarily, the lender's going to take your base pay, what you get now, yay, but your overtime and your bonuses are going to be averaged over 2 years.
Gotcha. Overtime's not guaranteed.
Overtime's not guaranteed, and you have to have at least been having it for a year before we can count it at all. If you just started getting overtime 6 months ago,
Wow.
not going to work for you.
Wow.
Self-employed people, it's your net on your tax return that we're looking at. We can add back in depreciation or ones that are just paper losses.
Yeah.
And we do have a lot of different specialty loans for self-employed people because they do, want to write off as much as they can.
Yep.
So the income is looked at sometimes differently from the borrower to the lender standpoint. As a good average, on your conventional loans, you cannot go over 50%, what we call debt to income ratio, which I'll explain in a minute. FHA, depending on if you're a good or a lower score FHA, up to 55% on your back ratio. Meaning if you take what the house payment's going to be, your principal, interest, taxes, insurance, private mortgage insurance, plus all of your other bills like that would show on a credit report, like your car, your student loans. And if you don't pay anything on your student loans, we have to take a 0.5% payment and put it on there for you because we know eventually it needs to be paid back, right?
Yeah. Okay.
Any rate, or your installment loans and so on. So if you add up all of those and the house payment that you're getting, that cannot exceed 55% of
what you make.
Of what you make, according to what the lender says you make.
Wow.
And the first can't exceed somewhere usually around maximum 43. Sometimes you can push it to 46, but it's on just the principal, interest, taxes, and insurance.
And that sounds like, solid financial, responsibility.
And
right?
that's if you want to live around a house payment. A lot of times you see people with the better credit scores because they don't want to max out what they can afford.
20, 30%, yeah.
Yeah. So at any rate, that would be for income. And then, of course, your down payment is just money. That's assets. And there are several different ways to get your down payment as well, too. If you don't have it in the bank, you can get a gift from a close blood relative, sometimes a significant other.
Yeah.
And the gift can help you with your down payment.
Got it.
Closing costs and so on, you can get seller or realtor participation, but the down payment has to either come from you or a gift, unless you're going with some type of down payment assistance program. Now, on the down payment assistance programs, most of the time you're paying a lot more on the interest rate and sometimes you're even having to pay to get assistance. So usually the only time you ever go with a down payment assistance program is because bottom line, you're going to be a renter forever if you don't.
Gotcha.
And then last thing, of course, is your credit score. And your credit score is what they look at is a mid score, and it's a mortgage credit score.
Gotcha.
A lot of times people have different programs that they access to give them what the credit score is for that, or they have a credit card that comes in and it shows them, one of their credit scores.
Mm-hmm.
So we look at, you have 3 credit scores. We take the middle one, and that's what your loan is based off of.
Well, so should they know that when they walk in, though?
A lot of times they don't.
Yeah.
They might know what one of their credit cards has given them as their score, or one of these programs. And the thing is, even if they belong to some system that gives them their credit scores and gives them all 3 credit scores, they're not necessarily mortgage credit scores.
Gotcha.
If you go to buy a new car, you're going to get 1 score. If you go to your insurance company, gives you another score. Credit cards give you a different score. There's different scoring models used for what you're purchasing.
Gotcha.
And so,
but when you're walking into Vicki's office, you probably know. Have you paid your bills or no?
Well,
sometimes you would think.
Now, for those who would go online and use, I don't want to call out a name of a company, but they're attempting to secure their credit score. Mm-hmm. And it's my understanding that you really need all 3, and it doesn't matter which one comes up. Whatever is the mid score, that's the score that you're going to use. But how good are these companies that are online that give you your credit score, or say they give you a credit score?
A lot of them use a different scoring model, but if somebody calls me and they say, hey, I ran my credit on XYZ and here's what I have there, and it has all three of them, and this is what it has, I'll say, okay, well, that's probably, we're going to be okay. Or if they call me and tell me what that is, I'll say, I know we're going to need some work. So, I mean, there's a lot of them I know that how to adjust it somewhat, but
Gotcha.
I won't know it for sure until I run their credit.
Yeah.
And one thing that's good is once I do run their credit, I do also have a program I can help tell them how to raise their score a lot of times,
Oh, that's
if
cool.
needed.
Yeah.
And if you would explain, what is rapid rescore?
Rapid rescore is where we tell them, okay, if you pay, right now I've got a client, he's got a 620. I said, look, if you'll pay these 3 credit cards down, you're going to go up to 680. If you can take and pay these 3 down, then I can do what's called a rapid rescore, meaning we reach out to the bureaus. We reach out to our credit bureau that we pull with, and we have them go to each Experian, Equifax, TransUnion, or at least 2 of them, because we only care about the mid-score, because it's expensive to do. You pay almost like $30 per trade line per bureau.
Oh, wow.
So at any rate, and so then it takes and it rescores them right away, so we don't have to wait for it to hit their credit, because a lot of times your credit cards and so on only sometimes not even once a month, but usually about once a month we'll give it. So depending on how quickly you're wanting to move, if you're not wanting to do anything for 2 or 3 months, hey, let's just wait and let it take its course, and eventually it will go up.
It'll pop up.
But if you want to hurry up and you're already under contract, then we have to do a rapid rescore, so then it changes in like 3 days.
Gotcha.
So
Okay.
Well, if I may, on that score, so let's say someone comes to you and the score is not what the creditors would like it to be, and a person says to you, well, how can I get my scores up? Is increasing your score the same as restoring your credit? Is that one and the same?
Well, restoring your credit to me sounds like you had good credit and you did something, now you're trying to bring it back. But it's the same effect. You want a higher score. Your score also affects your interest rate. So you really, just because you can get the loan doesn't mean you don't want to increase your score, because if you increase your score, a lot of times you'll also get a better interest rate. So another reason why we'll try to help people, if it's something quick and easy they can do. Sometimes there's people who have collections on their accounts, and you do not want to go and pay them, unlike what a lot of people believe, because if you go and you pay that collection, it changes the date of last activity. It could be 4 years old. Now you just went and you paid this debt, so now it changes from being a 4-year-old collection to your date of last activity last month when you paid it off, which lowers your score even more than helps it. So you don't want to just start paying off collections, because you could actually really lower your score
That is so
rather than
weird.
help it.
I just think
yeah,
that's-
it just doesn't make sense.
It doesn't make sense. Hey, I actually paid off something I owe. Penalty.
Yep.
It's a weird deal.
That's why I try to always make sure and tell people, wait, don't do anything until we run it on the analysis and find out what's going to happen. Now, if you can talk to the creditor and say, hey, if I pay you, will you delete this completely off of my credit?
Yeah.
Then, hey, that's always a good thing.
Yeah. Or if I just don't pay it, can you also delete it?
Woohoo! I
Yeah.
like this negotiating.
Also still delete it.
And then also something you can do is if your credits, if your limit's $5,000 on your credit card and you have it up to $4,900, you need to bring it down to at least under 30%. That's going to usually help.
So it looks like we're moving in here. I had a question about this, right? You mentioned earlier PITI.
Mm-hmm.
What does that stand for again?
That stands for principal, interest, taxes, insurance, and then you also, if you're not putting more than 20% down, need to add your private mortgage insurance.
Why? And this is just we talked earlier about group think, right? I'm in real estate, and you shake a lot of hands and you're talking to people, and this is an opinion, so I don't think maybe you might have factual data, but why is it that, or how is it, maybe it's a systemic thing, why is it that people get to this point where they're like, we can afford the house, and they always forget about the insurance and the taxes, right? I feel like I hear a ton of people that are like, I didn't get the house because I didn't qualify for the taxes and insurance. And I was like, well, you're like 35. I mean, you know that these are things we have to account for, man. You know, why is that? Like, is there some kind of information?
why.
Go ahead.
There's a lot of calculators out there when they put in the price of the house and whatever it is, and it only shows them principal interest.
What is the merit of that?
And so because a lot of the calculators out there are just trying to figure it, based on this interest rate and this much down, here's your principal and interest. But there's no way that calculator can tell them what their taxes and insurance can be. They can do an average, and some of the calculators out there are better when they're tied to a particular house.
Yeah.
Then that particular house, they might be able to tie in the taxes and insurance.
Pull that in, yeah.
But they can't even figure the private mortgage insurance because they don't know what type of loan they're getting or what their credit score is to how much they'll pay for it. But that's why there's a lot of calculators out there that only put the principal and interest on there.
So it just kind of sets a weird expectation when they walk in. They're like, look, I can do a $400,000 house. I know it. I'm at 40%. Bam, there's $8,000 a year in taxes and insurance.
Probably a first-time home buyer.
Yeah, but it's
never thought about taxes.
But
and
it's something
insurance.
to, it's like you shouldn't really use these calculators because they don't actually have all the information. The best thing to do is just go, I know everybody, consumer behavior has changed over time, right? Used to be we're going to go drive and then look, but now we want to look and then drive, right? So they're doing all this work and spinning wheels when they just need to go to the person that does it all the time, right?
Most of the time, most realtors out there nowadays want a pre-qualification letter from a mortgage company before they're going to put that person in their car and waste too much time with them.
Yeah, exactly. Hey, at least they've gotten with someone who knows what they're doing, looking at.
Yeah, then they'll and the mortgage person will bring it out to them, and they're like, what?
Yeah, here's your range, dude.
They should be giving them at least a worksheet, kind of showing them their expenses that they're going to be looking at.
Yeah, I think so.
The other thing that I think that those looking to purchase a home should be aware of is the HOA and property taxes. It seems that is what prices an individual, out of a certain area, a certain community. Would you say that is the case?
Yes, very much so. Most people want to know how much house can I qualify for, and really the correct thing should be what payment do I qualify for, because that payment can change depending on the taxes that they're going to be paying, because they can really change. Maybe over here it's 1.9 and over here it's 3.4, so the taxes will make a difference, and the homeowners association as well, because we will figure that into their debt to income ratio, because it is mandatory that you pay your homeowner association. It can be zero if it's not in a homeowner association, or it can be thousands of dollars depending on where it's at. So you're right, and that's why a lot of times we'll put, they'll want to know how much house can they afford, so we'll put on there kind of an average of what home range they should be looking at. But bottom line, we always have to put a caveat, but look at the taxes and insurance on that house as well. If it's an older home, maybe it's had a lot of insurance claims already. Maybe the insurance is going to be way higher on that, whereas a new home is going to be a lot less on insurance.
General home inspectors, how important are they when it comes to purchasing a home?
Okay, I would say that's always a good question to ask your realtor, but I am a real estate broker as well, although I do mortgages now more than anything, but I always suggest that you do that so that you know what you're looking at going into it. Even if you're buying a brand new home, there's inspectors out there that will go through and make sure all the steps are made properly.
Do any lenders or loan types really care about the inspection?
We don't want it. We do not want it in our file. We do not want to know, because that's more liability for us, and it's not anything that we take into consideration. If you're getting an inspection, we don't even want to know how much you paid for it or if you even got it.
Got it.
Now, the appraiser will go out there and inspect some of the major things, but they're not going to nitpick it like an inspector.
Sure. And
to make sure the foundation, the roof has 3 years on it.
Gotcha.
Big things.
Excuse me, Vicki. The appraiser, that appraisal is ordered by the lender, correct? And the survey is ordered by the title company. Is that correct? Okay.
Anybody can order the survey, but only the lender can order the appraisal.
Well, we've got a few minutes left. Paul, is there anything else that you'd like to ask Vicki concerning interest rates, home buying?
Yeah, I know, Vicki, you talk a lot about mortgages, and everybody wants to know, Vicki, what's my interest rate, or what are you doing, right? And it's always subject to, hey, it depends on how you go through underwriting, right? I can tell you, like we talked about earlier, the 4.75. Hey, that's what the banks are paying, right? The capital markets have to make their spread as well. But I wanted to really just ask you, in the same vein as earlier, what are things that people maybe misunderstand or just really need to know as a point of emphasis? I know we've talked about some stuff. When getting into a loan or looking for a loan, I mean, what should people know? What do you think is a secret that most of your clients are like, I didn't know that?
Well, I think that sometimes they'll just go online and make an application with their figures, and they'll get a pre-qual letter from just an internet type of loan. And at the end of the day, they don't really qualify.
Yeah.
So, because it's not looked at everything. Another thing that we didn't talk about are investor loans, that there's so many different out there that are owner occupied are pretty straightforward. The ones we talked about earlier. Investor loans, you can do so many different types. You can even do one just based off of the rental property income on what it's going to lease for and your credit score. So there's a lot of different loans we didn't talk about. Owner occupied, there's 12-month bank statements, 1-month bank statements even, that for your income. So we went over kind of your income as far as just your normal loans, but there are the specialty loans where you can base it on your deposits of your bank statements. The DSCR where you're basing it on the rentals. So there are different specialty type loans out there as well too, that you can maybe qualify for if you don't qualify for a normal one.
Okay, and that's a good point. So in your company, we've got investor loans, right? And when I hear that, I hear conventional, right? Like a bank loan, whatever you want to call them. Do you also use like alternative finance, like most people call them hard money or short-term money?
We do have our hard money lenders that we like to work with as well too. When
Okay.
bottom line, that's your last resort.
Definitely higher interest rate and fees, right? But
they have a purpose, and that's why they're there.
Okay, and so somebody that is investing, or maybe they own a home and they're like, look, I've got extra cash, I want to buy this. That's somebody that can come to you, again, same type of thing, right? The strategy of it, here's what we offer. Is it as credit score dependent on the investor loans, or is it more like I think you were saying like it's more like the house? How does all that line up?
No, the credit score does come into play
Okay.
as well too.
Okay, so credit score, and then I guess what they want to do with it, right? Do you want to flip it? Do you want to hold it for rental? What is it? Is it a retail center? Do you have like a limit to what you would be able to lend on?
There are different, well, I mean, it all depends on, no, there's no particular limit. I'm what you call a mortgage broker.
Yeah.
So as a broker, if you work for just one lender, you usually are limited to what you can do, because that lender will only do, certain types of loans.
Yeah.
As a mortgage broker, I can take somebody and I tell them, give me all the pieces of the puzzle, give me everything, and then let me see how I can make your prettiest picture.
Yeah.
And so therefore, as a broker, I go out to a lot of different lenders. So if it doesn't, so I try to look best, for the best thing that's for that borrower.
Oh, cool.
So if they can't do a normal, or we call it normal, your Fannie, Freddie, FHA, if they can't do that, then here's the next best thing to that. They can't do that, then we go on up the ladder till we get the one that's going to work for them.
Wow.
Or show them how long it would take them to fit more into the other bucket to where they could get a better deal.
That's awesome. They really do. Whoever's with you really does get to see all their options, right?
Yes. We can shop the loan for them at a lot of different places, so we're not tied to just one, here's what we do. And I take a lot of people who's been turned down from other lenders and I've got one closing Friday. It was turned down twice already by other lenders.
Did I not tell you? If she can't get it done, it can't get done.
That's right.
That's how good she is.
Yeah.
So
Vicki, on behalf of the management and staff of Finishes Solutions, we thank you for being our guest. And again, we thank you for the invaluable information you have provided. How can one get in touch with you?
you can definitely call our office, 281-370-8282, or you can call my cell phone, 832-435-1752. You can go to www.moneywise.fund. That's F-U-N-D, because we like to fund loans.
Well, we thank you. Paul, before we leave, let me ask you, if I were to approach you and I said, Paul, I'm looking for office, retail, mixed use space to lease, be it here in Waller or let's say greater Houston. What can Finishes Solutions do for me?
Finishes Solutions, one of the reasons why we have Vicki here is Finishes Solutions is really a strategist and a partner in any real estate need, whether it be leasing, buying, or selling. We like to say, it's Mount Everest, right? Mount Everest was there, everybody found it, but you can hire anybody to take you to the top, but you probably want to hire the guy that or gal that has been at the top to guide you up there, right? And that's what we are to homeowners. That's what we are to investors. We have the experience and knowledge of literally anything you want to buy. We've done it at a high level. And so I'd tell them, I'd say, hey, you're done searching.
So if I came to you and I said, my parents want to sell their home, it's a residential home, and I'm looking to put them in an apartment, but I'm not sure if it's the traditional apartment complex or if it's a 55-year-old plus complex, or I may just decide to put them in a townhouse. I mean, what could Finishes Solutions do for me?
Finishes Solutions can not only can we sit down, advise you of which one of these you would take your loving family to, but we would also, we'd give you the advantage of we can deliver things like pricing on renovations, right? Maybe we can get a good price on a property, but mom and dad are going to need that granite on the countertop, right? We can deliver that in-house. So we really are a one-stop shop, everything from development, construction, and buy and sell.
I wanted to add, we can also do loans where you can put those repairs into the mortgage.
There's also a really good chance you're going to go to Vicki's shop for the loans.
And if I were an individual that, let's say, owned a number of commercial buildings, let's say I owned about 15 of them for the past 15 years, and I wanted to sell off some of them because I'd like to buy a new building. I mean, what could Finishes Solutions do for me?
Yeah, so Finishes, the real power of Finishes within that scenario is that every number, right, outside of lending, that's Vicki, every number from commercial insurance, development, construction, selling your property, right? What's the price point? How are the appraisers going to look at it? How is the buyer or seller going to look at it? All those things will be brought to you in a single sheet proposal, right? Not only brought to you, but we would stand by the numbers that we give you for construction. So it's really something that's unique. I think a lot of people try to do it, but we really are able to deliver full scale and full picture to our clients, our commercial clients for sure.
Well, I thank you, Paul Cates. In addition to serving as president of Finishes Solutions, Paul Cates is co-host of the Realty Project podcast. I would like to say this before I go. Vicki, would you not agree that investors nowadays are using commercial property versus banks, that they're putting their money and holding it in apartments, plazas, versus putting their money and leaving it in a bank?
There are so many advantages to real estate for investing, for tax purposes and different things that yes.
Well, listen,
the answer is yes.
Well, at Finishes, we can help you. Again, my name is Jay McLaughlin. My co-host is Paul Cates. You've been watching the Realty Project podcast. This is our first podcast of the new year. So, Paul, we did not get a chance to say Happy New Year to everyone. So we wish you Happy New Year,
Happy New Year.
Optimum health, tremendous productivity, and as a result, the opportunity to prosper. Again, this is the Realty Project podcast.